Denmark's tax system often appears both impressive and intimidating from the outside, and in this video, we will walk through how it actually works in a clear, structured way, so you can understand the core mechanics behind one of the world's most comprehensive welfare models. We will start with the big picture, then move into personal income taxes, VAT and other major taxes, and finally discuss what Danes receive in return and what this means for individuals, businesses, and policymakers. At the highest level, Denmark is a high-tax, high-service economy. Taxes fund a broad Nordic welfare state that includes universal health care, free or heavily subsidized education through university, extensive parental leave, unemployment benefits, and a strong social safety net. Rather than relying heavily on corporate taxes or wealth taxes, Denmark's system is primarily built on three pillars: personal income tax, value-added tax, and social contributions embedded within the overall framework. The focus is on taxing income and consumption consistently and transparently while keeping administration relatively simple and predictable. Turning to personal income tax, this is where Denmark is best known for its high rates, but the structure is more nuanced than a single number suggests. Danish residents are taxed on their worldwide income, while non-residents generally pay tax only on Danish source income. The system applies progressive taxation through several layers that combine state, municipal, and labor market contributions. At the core, individuals pay a municipal tax that varies by municipality, but typically falls within a relatively narrow band. This rate is flat within each municipality and applies to most forms of taxable income. On top of that, there are state taxes applied in brackets, where lower levels of income are taxed at a basic state rate, and higher levels of income are subject to an additional top tax. Combined, and after including mandatory labor market contributions and church tax for those who are members of the national church, the marginal tax rate on higher incomes can approach or slightly exceed 50%, although this figure can vary by year and municipality. A critical feature is the use of deductions and allowances to moderate the effective tax burden. All taxpayers receive a personal allowance that is deducted from taxable income before calculating the final tax. There are also deductions for pension contributions within certain limits, interest expenses on loans such as mortgages, and specific work-related expenses. Social Security in Denmark does not operate through large separate payroll taxes in the same way as in many other countries. Instead, much of what other systems fund via social contributions is embedded within the broader income tax framework and general budget. Employers and employees do pay certain labor market contributions, but compared with many European peers, the complex web of employer social charges is relatively restrained, and the state takes a more central role in funding welfare obligations from general revenues. For many individuals, the primary visible employer-side cost is agreed wages, plus a limited set of statutory contributions. Moving to corporate taxation, Denmark applies a standard corporate income tax rate that in international comparison is moderate rather than high, and this is deliberate. The strategy has been to place more of the overall tax burden on personal income and consumption, while keeping the corporate tax rate at a level that remains competitive for investment. Corporate profits are taxed at this single rate, with rules governing the deductibility of expenses, the treatment of interest, and the taxation of cross-border income in line with OECD standards. Dividends and capital gains at the shareholder level are generally taxed, often at progressive rates, but there are special rules for substantial shareholdings and corporate investors to reduce economic double taxation of profits. One of the most important elements of the Danish tax structure is VAT, or value-added tax, which applies to most goods and services. Denmark has a relatively high standard VAT rate, and unlike some countries that rely heavily on multiple reduced rates, Denmark uses a single broad rate with limited exemptions. Basic items like groceries, most services, and consumer goods are all subject to VAT, while certain sectors such as financial services and some cultural or social activities may receive partial or full exemptions. For consumers, This means that a significant part of what they pay for everyday purchases is tax. But the system is efficient to administer and generates a large, stable stream of revenue for the state. In addition to VAT, there are several excise taxes that target specific categories such as energy, fuel, alcohol, tobacco, and certain environmental externalities. Denmark makes extensive use of green taxes designed to influence behavior around energy use and pollution, reflecting broader environmental policy goals. Property taxation is another important but sometimes misunderstood component. Danes face property-related taxes that typically include a municipal land value tax and, at times, a state tax on the assessed value of real estate, though the precise design has been subject to reform and recalibration over time. These taxes are intended both to provide municipal revenue and to support housing affordability and stability, and they are periodically adjusted to better reflect market values and policy priorities. Inheritance and gift taxes exist, but they are more modest and targeted than wealth taxes seen in some historical contexts. There is no broad annual net wealth tax. Instead, transfers above certain thresholds, particularly those outside the immediate family, may be taxed at defined rates. The Danish tax system also prioritizes simplicity and digitalization. The vast majority of residents do not manually complete complex tax returns each year. Instead, the tax authority, known as SCAT, pre-populates individual tax statements based on information automatically reported by employers, banks, pension funds, and other institutions. Individuals then review this information online, make corrections if needed, and approve. This high degree of transparency and automation aims to reduce administrative burdens, minimize errors, and support a culture of compliance. From a behavioral standpoint, the combination of high tax rates and high-quality public services reflects an implicit social contract. Individuals pay substantial taxes but receive healthcare, education, infrastructure, and social protections that, in many systems, would either be privately funded or not available at all. While marginal tax rates at the top are high, Denmark also offers a relatively compressed income distribution and strong public services that reduce the need for private spending on essentials. For lower and middle-income households, the interplay of taxes and benefits, such as child allowances, housing support, and subsidized childcare, can significantly affect net disposable income. For businesses and investors, the key takeaway is that Denmark offers a predictable, rules-based environment with moderate corporate taxes, a well-educated workforce, and strong institutions, financed by high personal and consumption taxes. The result is a system that trades lower take-home pay in exchange for reduced personal risk around health, unemployment, and old age. This model is not without challenges. It requires high levels of trust in public institutions, careful management of incentives to work and invest, and continuous adjustment as demographics and economic conditions evolve. Yet, despite these challenges, Denmark consistently ranks highly in measures of competitiveness, ease of doing business, and overall quality of life. To summarize, Denmark's tax system is best understood as a coherent architecture rather than a collection of isolated rates. Progressive personal income tax combining municipal and state layers, a broad and relatively high VAT, targeted excise and property taxes, and moderate corporate taxation, all underpinned by efficient digital administration and a robust welfare state. Whether you are considering working in Denmark, investing, or simply learning from its policy design, the central insight is that the tax system is inseparable from the services and security it funds. Understanding that connection is essential to making sense of how and why Denmark has chosen to structure its taxes the way it has.